Assalamualaikum warahmatullahi wabarakatuh to our respected lecturer, Dr. Muhammad Sukur bin Jaafar. Today, we will be presenting about the best performing stock in our simulated portfolio, which is Nestle Malaysia Berhad. Before we begin, let me introduce my group members. We have Nur Ain Zulaika binti Zamri, Nura Azza Eva Natasha binti Rosli, Nur Izazi Atira binti Razali, Syahidatul Adrana Natasha binti Tobari, and myself Adrana Badlisha binti Abdul Latif. From our portfolio, Nestle shows strong financial stability, consistent dividends, and stable price movement. We choose the food and beverage industry because it is defensive and less risky. Nestle has strong brands like Milo, Maggi, Nescafe, and KitKat, and it is the largest halal hub for Nestle globally. In this presentation, we will focus on two parts: fundamental analysis and technical analysis to support our investment decision.
Assalamualaikum. My name is Nur Azza Eva Natasha. For this part, I will present the executive summary of Nestle Malaysia. First, Nestle Malaysia is one of the leading FMCG companies in Malaysia under the global Nestle Group. The company offers a wide range of products such as Milo, Maggi, and Nescafe, and it has strong brand loyalty among Malaysian consumers. Next, the FMCG industry is stable because it is driven by essential daily consumers' demand. However, it is highly competitive as it involves both multinational companies and local brands offering similar products. Moving on to fundamental analysis, Nestle shows strong financial stability with consistent revenue and profit performance. This is supported by strong branding and a wide distribution network. However, the company is still exposed to risks such as raw material, price fluctuation, and currency change. For technical analysis, Nestle is considered as a defensive stock with a low volatility. Its price movement is generally stable in the long term, although short-term upside is limited. Next, for the investment decision, Nestle is suitable for a long-term investment because it provides stable returns and strong brand support. It is a low-risk defensive stock, making it suitable for conservative investors. Finally, in conclusion, Nestle is a strong FMCG company with stable performance and consistent demand due to essential goods. Overall, it is more suitable for long-term, low-risk investment strategies. Next, I will pass it to the next presenter.
So now, I will continue with the overview of Nestle Malaysia Berhad. Nestle Malaysia Berhad is the leading food and beverage manufacturer in Malaysia with a history dating back to 1912. Listed on Bursa Malaysia under stock code 4707, the company operates in the food major diversified industry. Its core business include dairy and nutrition, prepared foods, beverage and coffee, confectionery and ice cream, and ready-to-drink products with well-known brands such as Milo, Maggi, and Nescafe. Nestle is also the market leader in Malaysia's FMCG industry and serves as the largest halal manufacturing hub within the global Nestle Group. Backed by its parent company, Nestle SA, it maintains strong financial stability and resilience during economic uncertainties. The Malaysian food and beverage industry continued to grow due to increasing population, urbanization, and consumer demand. Although the industry faced challenges such as inflation and rising raw material costs, opportunities remain through healthier product trends and digital transformation. Now, moving on to the fundamental analysis. Between 2021 and 2025, Nestle recorded a 4.66% revenue CAGR, showing consistent sales growth. Although net profit, EPS, and dividend per share declined slightly due to higher commodity costs and inflation, the company continued to reward shareholders with stable dividend payments. For profitability, Nestle's net profit margin is 8.55%, slightly below the industry average. However, its return on equity of 92.66% and return on assets of 14.83 are significantly higher than the industry average, indicating strong efficiency in generating profits. Looking at the valuation metrics, all of Nestle's valuation ratios are higher than the industry average. This reflects investors' confidence in the company's strong brands, stable earnings, and long-term growth potential. In terms of dividend, Nestle offers a 2.26% dividend yield with an 85.92% payout ratio, demonstrating its commitment to providing stable returns to shareholders. Lastly, the company has a debt-to-equity ratio of 1.67 and a current ratio of 0.52. Despite relatively high leverage and tight liquidity, Nestle remains financially resilient because of its strong cash generation and market leadership.
Now, let me present the comparative analysis between Nestle and its competitor Dutch Lady. We compare 6 key financial metrics to see which company performed better. First, revenue. Nestle recorded about 6.9 billion ringgit, which is more than 4.5 times larger than Dutch Lady. This shows Nestle dominant market position. Second, net profit margin. Nestle margin is 8.55%, higher than Dutch Lady at 6.88%. This means Nestle is better at turning sales into profit. Third, ROE. Nestle ROE is exceptionally high at 92.6% compared to Dutch Lady at 18.02%. This proves that Nestle management is very efficient at using shareholder money to generate profit. Fourth, DE ratio. Nestle use more debt at 1.67 compared to Dutch Lady at 0.16. More debt helps Nestle grow faster but also increase financial risk. Fifth is DPS. Nestle pay 220 cent dividend per share, much higher than Dutch Lady at 50 cent. This shows Nestle's strong cash flow and commitment to rewarding shareholders. 6. PE ratio. Nestle trades at 38.15 times, while Dutch Lady is at 90.22 times. Nestle is more expensive, but investors are willing to pay more because of its strong brand and stability. In conclusion, even though Nestle is more expensive and has higher debt, it is still the better choice because it gives higher profit, better management efficiency, and bigger dividends. Nestle's strong banks make it a safe and stable long-term investment. That's all from me. Thank you.
Next, let's look at the Nestle Malaysia qualitative factor, which refer to the non-financial aspect that influence the company long-term performance. Nestle demonstrates strong qualitative fundamental through its well-established and brand reputation, experienced management, and excellent corporate governance, which enhance customer trust and investor confidence. The company also focuses on ESG initiative, continuous product innovation, high product quality, and its leadership as a global halal production hub, helping it remain competitive and resilient in the market. However, one qualitative risk is its reputational challenge due to consumer boycott sentiment, which may affect brand perception and consumer demand. Overall, despite this risk, Nestle Malaysia maintains strong qualitative strength that support its long-term business sustainability and growth.
Next, I will present the technical analysis of Nestle Malaysia Berhad based on its daily candlestick chart. The chart shows that the stock has been in a clear bearish trend throughout the analysis period. The share price declined from approximately RM121 in early January to RM91.20 in early July, representing a loss of about 25%. During this period, the stock consistently formed lower highs and lower lows, which is a classic indication that sellers are dominating the market and buying demand remains weak. Although there was a temporary recovery in early May, when the price increased to around RM108, the upward momentum could not be maintained. The stock later resumed its downward movement and traded within a narrow range between RM92 and RM96 before falling back to around RM91. This suggests that investor sentiment remains cautious and the overall market direction is still negative. Looking at the moving averages, the current price of 91 ringgit 20 cent is trading below all the major moving averages, which confirms a strong bearish outlook. The 5-day moving average is around 96 ringgit, the 50-day moving average is approximately 112 ringgit, and the 200-day moving average is around 108 ringgit. Since the current price is below all of these levels, both of the short-term and long-term trends remain weak. The nearest support level is 90 ringgit 52 cent, which is today's low, while the psychological 90 ringgit level acts as another important support. If the price falls below 90 ringgit, it may continue declining towards 88 ringgit or even 86 ringgit. On the upside, the first resistance level is 96 ringgit, followed by 100 ringgit and the stronger resistance at 112 ringgit. Therefore, the price needs to break above 96 ringgit before any meaningful recovery can begin. The technical indicators also support the bearish trend. The RSI is currently at 37.24, which is below the neutral level of 50. Although it has not yet entered the oversold zone below 30, it indicates weakening momentum and suggests that the price could still move lower. The MACD remains below both the zero line and a signal line, confirming that selling pressure continues to outweigh buying pressure. In addition, trading volume is relatively low at only 74.6 thousand shares. This indicates that there is no panic selling, but at the same time there is also limited buying interest. Overall, these indicators suggest that the current downtrend remains. In addition, other technical indicators including the stochastic, CCI, Williams percent R and ADX also indicate weak buying momentum and confirm that a strong downward trend is still in place. Furthermore, all 6 moving averages from MA5 to MA200s are giving all sell signals, showing that sellers remain in control across all time frames. In conclusion, Nestle Malaysia Berhad is still trading in a strong bearish trend. Investors should continue to monitor the 90 ringgit support level closely. A stronger recovery will only become more likely if the price moves above 96 ringgit, the RSI rises above 50, and the MACD turns positive. Until these signals appear, a cautious approach is recommended.
Next, I will present the investment analysis and justification for our portfolio ultimate defensive anchor, Nestle Malaysia Berhad. Starting with our stock selection rationale, Nestle represents unparalleled operational stability from 2021 to 2025. The company delivered a resilient revenue CAGR of approximately 4.7% with fiscal year 2025 earnings per share hitting 280 ringgit 70 cents. For income-focused strategy, Nestle is a premium choice, offering a robust dividend per share of 2 ringgit 20 cents and a reliable 3.76% forward yield. As Malaysia's largest FMCG giants and global halal hub, its airtight competitive moat completely shield it from new market entry. At the risk-return profile, Nestle provides an excellent low beta consumer staple cushion that insulated our portfolio from heavy market swing. Its 14 days average to range is tightly constrained at just 50 cents, provided short-term price volatility is remarkably low. Powered by immense brand pricing power, Nestle easily protects its margin, while positive institutional momentum from RSI and MACD support a safe medium-term accumulation strategy. Our fundamental and technical analysis heavily aligned. Fundamentally, Nestle maintained a strong 7.5% net profit margin despite global cost inflation. Backed by a near 100% dividend payout policy, technically the stock sits at a healthy, natural 55 ringgit 60 cent with powerful chart pivot support established around 95 ringgit to 95 ringgit 40 cents, giving us highly reliable entry point. In conclusion, Nestle combines top-tier income visibility with low market risk, making it the perfect core defensive holding for our portfolio.
Lastly, I will conclude the analysis and highlight the key lessons that we learned from this study. Nestle Malaysia Berhad is a strong defensive FMCG company with stable financial performance, supported by strong brands such as Milo, Maggi, and Nescafé. These strong brands help the company maintain consistent consumer demand and long-term market stability. The FMCG industry remains stable because it is driven by essential consumer demand, and this makes it resilient even during the economic downturns. However, the company still faces risks such as raw material price fluctuation, currency changes, and increasing market competitions. From this analysis, we can learn that strong brand equity plays an important role in ensuring long-term businesses' sustainability. In addition, FMCG companies are generally more stable but offer limited short-term capital gain potential. Furthermore, fundamental and industry analysis are important tools in making better and lower risk investment decisions. Overall, defensive stocks like Nestle are more suitable for long-term investment strategies that focus on stability, low risk, and consistent returns. That is all from our group. Thank you.